I've been in portfolio management for 15 years, and I'm going to tell you something that doesn't get said enough. The highest yielding dividend ETF is almost never the best one for your wealth. In fact, I've watched it be the worst one. Last year, I was reviewing a client's portfolio, let's call him Tom. He'd built a position in what looked like a steal, a dividend ETF yielding 2%. He thought he'd found the holy grail of passive income. 6 weeks later, the distribution was cut by 58% and his portfolio was down 34%. He didn't lose just yield. He lost capital. A lot of it. That's the dividend trap. And I'm going to show you exactly how to avoid it. Let's start with the fundamentals. When you're looking at dividend ETFs, you're probably comparing yields. That's the first mistake. A 10% yield looks twice as good as a 5% yield. Mathematically. On a spreadsheet, it is. But in reality, a 10% yield that gets cut to 4% is infinitely worse. Let me give you context. Right now, a fund like SCHD, which is Schwab U.S. dividend equity ETF, is yielding around 3-5% with an expense ratio of just 0.06%. VIM, the Vanguard High Dividend Yield ETF, is sitting at approximately 2.9% with a 0.08% expense ratio. These aren't flashy numbers. Nobody gets excited about 3-5%. But here's what I've seen over decades. Consistent, sustainable yields beat unsustainable ones by a factor of 10 when you measure actual portfolio returns over 10 years. The difference isn't yield, it's safety. And safety is the foundation of every wealth-building strategy that actually works. So how do you spot the trap? There are 3 metrics I check first every single time. I'm going to walk you through them because these are non-negotiable. The first metric is payout ratio. This is simple math, but it's where most people fail. The payout ratio tells you what percentage of a company's earnings are being paid back to shareholders as dividends. If a company is earning $10 per share and paying out $9 in dividends, that's a 90% payout ratio. That's dangerous. That leaves almost no room for error, no capital for growth, no buffer when revenue dips. In my experience, sustainable payout ratios lie between 40% and 65%. Anything above 75% is a red flag. Anything above 85%, that's a siren. When I helped a client audit a high-yield ETF back in 2022, we found that the portfolio-weighted average payout ratio was 82%. Within 4 months, 3 of the top holdings cut their dividends. By month 6, the fund's distribution had fallen by 52%. The client had moved in at what he thought was a 8% yield. It became 1% by the end of the year. You find payout ratios on any financial platform. FactSet, Bloomberg, even Yahoo Finance gives you this data. Cross-reference it with the fund's holdings. Add it up. Average it. If it's north of 75%, you're holding a risk that most people don't understand. The second metric is dividend coverage, specifically free cash flow to dividend ratio. This is different from payout ratio because it measures cash, not accounting earnings. And cash is what keeps dividends alive when business gets difficult. Here's the formula. Take the company's free cash flow and divide it by the dividend payment. If you get a number below 1.2, that means the company is paying more in dividends than it's generating in actual cash. That's a trap. It means they're either borrowing money or depleting reserves to pay you. Neither of those situations ends well. When I reviewed a portfolio last year that was chasing a 5% yield, I found that the underlying companies had an average free cash flow coverage ratio of 0.94. That means they were paying more in dividends than they were generating in cash. That portfolio's distribution was cut 60% within 3 months. I'm not exaggerating. It happened exactly that way. The client got lucky. We spotted it before he'd fully deployed his capital. The third metric is sector concentration. And this is where a lot of sophisticated investors miss the trap entirely because it's not intuitive. High dividend portfolios often concentrate in specific sectors. Energy, utilities, telecommunications, real estate. There's nothing wrong with those sectors. But when 35%, 40%, even 50% of your dividend ETF is concentrated in a single sector, you're not diversified. You're leveraged to a thesis. And if that thesis fails, your entire portfolio gets hit. In 2022 and 2023, I saw dividend portfolios that had 47% in energy and utilities get absolutely crushed when interest rates rose, and those sectors corrected 30% to 40%. The yield looked safe on paper. The diversification looked fine because they held 100+ stocks, but the sector bet was concentrated enough to destroy returns. For comparison, SCHD has a much more balanced approach. Technology is roughly 12% of the portfolio, healthcare about 18%, financials roughly 20%. It's genuinely diversified. That balance is why it's 3-5% yield is sustainable. Now let me show you what this looks like in practice. Let's say you have $50,000 to deploy in a dividend strategy. You could put it into a 8% yield ETF and take your chances. At that yield, you'd be looking at roughly $5,400 per year in distributions. That sounds amazing. Over 10 years, if the yield stayed constant, which it won't, but let's pretend, you'd collect $54,000 in dividends. But here's what I've seen. That 8% yield gets cut to 5% by year 3. Now you're collecting $250 per year instead of $5,400. That's a loss of $150 per year in income. Over the remaining 7 years, you lose $22,050 in cumulative income versus your original expectation. Plus, your capital was down an average of 32% during the cutting period. Alternatively, take that same $50,000 and put it inched at 5%. You're collecting $1,750 per year. Over 10 years at a consistent 5% yield, that's $17,500, underwhelming on paper. But here's the difference. Payout ratio is sustainable at roughly 62%. Its free cash flow coverage is solid. The sector concentration is balanced. The distribution won't get cut. More importantly, SCHD has historically raised its dividend every single year. Between 2014 and 2024, SCHD dividend grew at an average annual rate of approximately 2%. That means your yield on cost compounds. If you'd invested that $50,000 in SCHD 10 years ago at a 1% yield, you'd be collecting dividends today at an effective yield on your original cost of roughly 8%, not because the fund's yield jumped, but because the dividend per share grew. That's compounding. That's real wealth building. Here's the metric I want you to focus on going forward: dividend growth rate, not current yield. Growth rate, which we've referenced, has a 10-year dividend CAGR of approximately 2%. VYM's is roughly 8%. JEPI, which is the JP Morgan Equity Premium Income ETF, and yields around 2%, has significantly shorter history, but its structure is synthetic option writing, which is a completely different risk profile. Compare apples to apples. When you're evaluating a dividend opportunity, ask yourself 3 questions. Is the payout ratio sustainable, below 65%? Is the free cash flow coverage above 1? 2. Is the sector concentration balanced? If you can answer yes to all 3 and the fund has a history of dividend growth, you found something worth owning. Not the highest yield, the best yield. One more thing before we wrap: backtesting. You can do this yourself. Take any dividend ETF you're considering. Go back 5 years. Chart the yield, the distribution amount, the share price. Look at what happened during downturns. Did the distribution get cut? By how much? When did it recover? What was the total return including reinvested dividends? This matters because total return, not current yield, is what builds wealth. I've seen too many investors get seduced by a 10% yield and miss the fact that the fund cut that distribution 3 times in the previous decade. That history is predictive. It tells you what will happen in the next downturn. Your dividend strategy should be boring. It should be sustainable. It should generate growth through compounding, not through chasing yield. A 5% yield from SCHD that grows